Everyone, welcome to today's session. Let's get underway here. It might be a little bit shorter session today. I've got a couple of technical issues I'm dealing with on a couple of different things. So we'll see how long we can sustain today. And we'll just hit some of the major topics early on here and get outside and enjoy some sunshine today, at least where we're at. Spring is starting here, which is kind of nice. So market conditions, we are back to bullish in a bull market. Overall trend of that, bullish rank of that is at 20.53, which just is an indication of where this line is currently. As I mentioned before, when that starts to get to these levels, it traditionally has not been this to these ranges very often. Above 20, about 3 or 4 times in the last 10 years, 5-10 years. Really the last 5 years, we've seen it, I think 2 or 3 times on some of these market peaks right here. So it can certainly, it's a slower moving indicator because it is taking into account all of this trend right here. So once that price action starts to turn, we'll see this start to flatten out. And then ultimately, you know, it's looking something like this. This move right here was this move here on the chart. So as it was spiking up in this uptrend, retracing and then moving higher. So the real question right here is how much more upside is attainable without a decent retracement, or how much more upside is attainable at all if we're going to start to see any of these factors that have been discussed for so long going to come back into the market, or if the demand and the buying demand of AI and the perception that it's going to create so much productivity is continuing to drive this momentum boom right now. We shall see. If we take a look at, let's look at buy-sell ratio. It has weakened. It's sitting at less than 1.78 and sitting right here around that. You can see that we've got 1756 and 1362 on buys and sells. We're also seeing across indices. Now, the interesting thing here, we've talked about this before, is just 3 or 4 days ago, this number on the Dow was up to 7 or 8. S&P 500 as well was really high. So just the last 2 or 3 days have really knocked the soup out of some of these upper momentum stocks, and they've just moved back into this hold range. Some have moved back over into this downtrend range, but essentially the bulk of the stocks currently across these indices, and really these indices have been powering this rally and the handful of stocks that are in those indices. So I'm going to spend a little bit of time talking about this 14 number and this 175 number and even this 22 number. We'll go through and look at that as really a quick location to be able to look for some of the super, mega cap, large cap powerhouses that are in the market right now, and those that are continuing to lead. It's a great place to look for those that are continuing to lead the market. We can get an idea of some of those here. We'll come back to this. I wanted to touch on a couple of concerning points as well, as far as cracks in the current trend. Sector ETFs, we're starting to see more of those ETFs moving back to hold and down and short-term downtrends. And so we are seeing, typically in those good, solid, nice uptrends, we saw all of these in the buy zone. And that's been going back and forth. A lot of volatility right here at the upper end of this current bull market and trend, where nobody wants to be selling right here because of the possibility of more upside. Nobody wants to be buying aggressively because we're at the upper end of this range. So it's an interesting time. I'm tug of war, and we'll ultimately see which one ends up winning. Now, in addition to that, one of the other pieces of data to be discussing, and that is this move on the bonds right here, where we've got some retracement. And I mentioned this in this morning's update as well. We have this, so let's rewind a little bit. Back in November, bonds had really just completely been obliterated, completely fallen off the table. And ultimately we got this initial spike right here. This initial spike in bonds triggered the rally in equities. And we know why. Those of you that are here know why, because we talk about it each week. And that is because interest rates are the main focus. Interest rates and inflation have been the main focus for the last year, 18 months to 2 years, and are probably going to continue to be the main focus for the rest of this year. At least that big, that big potential headwind that is just the boogeyman that's out there still watching and waiting for this overall market, at least for it to creep in. It's still there. The fact that bonds have had a rally and a retracement, in terms of the big picture, if we go back a couple of years, you can see that bonds are still in a pretty significant downturn over the last 2 years. So this little rally that we've had, this was from November of last year, and we had the retracement here, and now we're sitting right here. So there is some risk right here of these areas. If we were to break through these resistance areas and continue to slide, that, and if we get maybe some really hot inflation numbers still, those inflation numbers are going to be the key to the Fed lowering interest rates, because ultimately what they're trying to do is they're trying to slow that inflation. Inflation is just simply the cost of goods and services increasing, and the more demand there is for those goods and services, then the higher the prices are going to go. So what the Fed tries to do is lower the demand by removing money out of the system, number one, and also making interest rates higher so that it's harder to borrow money and then go spend it on stuff, okay? Whether that's home equity lines for us as consumers or companies as well. Maybe they want to borrow more money to be able to grow. That ability to borrow money, it's still there, but it's just at a more expensive rate. So there's a barrier to entry in additional spending, which is that additional demand. And so that is an issue that is going to, it's not gone, and it's not going away. And we also know that that's not going away when we look at this bond yield curve. We've talked about this and touched on this from time to time, that this is an inverted yield curve still. This is an unhealthy yield curve. Okay? When you have a 2-year treasury that is essentially paying more than a 10-year treasury, and when you have a 3-month treasury that is paying more than a 30-year bond, that is an inverted yield curve. Okay, so the reward is in the shorter term money. It's not in the longer term money. So there's no reward in locking your money in for a long period of time. That's kind of what the whole point is the shorter term is not going out real long term. This has to correct itself at some point. And I've mentioned this before. The way that it should look is something like this. Okay, healthy bond yield curve looks like this when you have lower interest rates, or shorter maturity interest treasuries that pay less amount. Okay? And it would make sense that the longer I'm tying up my money, the higher the interest rate I should be getting, the higher the yield I should be getting, versus the shorter amount of time I'm locking that money up, I'm not getting paid much. That typically is a healthy looking bond yield curve. And when we look back in the past, every one of these market tops, you've got a flat, high interest rates and a flat or inverted yield curve. That was 2000, 2001. This was 2007, 2008. Similar type of feel right here, and then ultimately you get this retracement back down here, and that corrects it. Well, throughout this entire bull market that we had the last 10 years, just watch this yield curve. Interest rates have been so low, and really at a really healthy yield curve, lower interest rates, that's just been a massive pump of money into the system, which has been ultimately a good thing, until it stops being a good thing. Okay, now we got a flattening yield curve here. Interest rates are lower. We had COVID. During COVID, you can see how low rates went as well, almost zero, all the way up to the 5-year note, 0.27. Okay, that's what created the inflation. So much money, all of the stimulus checks, in addition to super cheap money. It just flooded the system, and that money had to go somewhere, and it goes into assets that ultimately are inflated now. So this is our yield curve essentially as of right now. How is that going to correct itself is yet to be determined currently, but it is an additional headwind. And the other headwind that we're running into today is also looking at commodities, and that oil. If we see oil, let's see what it's doing today. didn't want to go out 2 years. I only want to go 6 months. But another update today, a percent, a nice move yesterday as well. So it's gaining momentum. It's gaining strength in this overall uptrend. That again, that's a potential headwind. So we're still dealing with high interest rates, which is mortgages, cars. For us as consumers, that's the bulk of where we're spending our money in an interest rate type environment. Same with credit cards and those different things as well. We also, so that's kind of the market setting right here. And we look at S&P 500. That's not S&P 500, but S&P 500 here. Just this long flat consolidation now for really all of almost all of March now. What are we at? 19 days into it has been just this kind of this flat range bound market. Nothing too exciting to the upside, nothing too scary to the downside, just relatively flat. It's been a relatively healthy corrective type pattern, and that is ultimately what we want to see in this market right here, is just have it consolidate. The probabilities of it continuing just to moonshot straight higher without some kind of retracement, they just get smaller and smaller the deeper you get into this trend. So it's going to be, we've got an interesting 6 months ahead of us, really. Now let's go back to the index tab here. Now remember a couple of things here. This is a quick glance. If you're looking at Dow and you're saying, all right, of these 14 stocks, which Dow stocks might I consider? Or which Dow stocks are currently performing well? You can certainly just pull those in. We obviously know General Electric is doing well. And that overall uptrend, nice, another 2% on General Electric today. Caterpillar is moving higher. JP Morgan is moving higher. So really, all of these stocks, Microsoft, they're in that upper momentum zone. So as you're looking at some of these names as well, Walmart, Walmart's in that upper zone. Visa, momentum zone. These are the stocks in terms of looking at that, some of these real big names that are in the Dow or they're in the S&P 500, and you're asking yourself, well, which stocks in the Dow should I focus on? Well, should I focus on these 5 stocks? Should I focus on McDonald's because it's in this downtrend? No, that's not our methodology. We want to be focused on stocks that have already moved back up into this range. They're in that upper buy zone. So it's a very simple decision to say what I consider McDonald's right here. No, not based on a momentum strategy, potentially on a reversal, possible counter trending strategy if it's starting to find some support right here. But we want to give it a little bit more time. So it makes it easy to say, Nike, not interested right here. Why? Because it's sloping down. It's in a downtrend. Until it proves to us that it's not going to be in a downtrend, meaning, and this is a good example of a whipsaw. It's attempting to prove to us that it is starting the new uptrend, but then it doesn't. That's why we have stop losses in place. And even this would have probably not been an ideal trade because it's so low in the retracement. Probably had some kind of, I think Nike did have an earnings report or an issue right here. It gapped lower, continue that overall downtrend. This would be early enough in that downtrend that I would probably say, let's just wait. Let's just give it a little bit of time. Let it get its momentum back together again. But right now it's just, everything's down. It's in a healthy downtrend. It's not worth considering. It makes it for an easy sorting process as well. Boeing, same story right here. Okay, for whatever reason. Now, again, all of the reasons, we never quite know. There are probably some very main obvious ones. If you're really focusing on the stock and really familiar with the company, then there may be earnings are declining, contracts are declining, risk of their Boeing plane crashes, or whatever the scenario is, or it could be the market saying, we don't think that Boeing is going to be able to fulfill on the backlog that they've got, or deal with, create your own thesis, whatever that might be. The fact of the matter is, it's just in a nasty downtrend. I don't want anything to do with it right here. Okay, so that's a momentum strategy. Now, a contrarian type strategy, contrarian meaning kind of the opposite of what everyone else is doing, is saying this thing has gotten beat up. Maybe now it's at support. Maybe now is an area, if I'm a longer term investor, that I might start to dabble in a stock like Boeing. But in the meantime, there's no reason to. It's just not working. Okay? And I say the word working because that's what we want. And working is, we want a stock that looks like this. Okay, we want to play with stocks like this. I shouldn't say play, I should say we want to trade stocks like this or be interested in stocks like this. Primarily, the ones that are working, they're moving this direction on a stock chart. They're moving up, they're retracing, they're moving up, they're retracing, they're moving up, they're retracing, they're moving up, they're retracing. Okay, and those are going to typically have high ranks. They're going to be ranked above 80 or even above 90. You're gonna have plenty of stocks to look at above 90 at that level. Now let's go into S&P 500. That might be just a little bit different list. It's a little larger group. Let's go to the S&P 100 right here and see what that pulls in. So you're going to get some of these other ones as well, but you're now getting Oracle. Oracle had a big pop the other day on earnings, moving higher. You're getting Alphabet, which is Google. Okay, Google had a gap this morning as well, but it has kind of been floundering. You're getting, MasterCard, Allstate Insurance. Here's a nice uptrend, little sell signal, back to the new uptrend, new buy signal. Okay, and that is, when we get into this zone, we know what about stop losses. We know that we have to protect our capital. We know that a stop loss is one of the ways that we do it. We know that position size is the other way that we do that. The size of the trade that we're holding and how long we're holding that in terms of at what point in a downtrend are we going to say, okay, I'm not willing to wait that out anymore. I'm not willing to see if it's going to stop or if it's going to become a Boeing, right? At what point in that downtrend of Boeing would we say, oh, crap, all right, well, I guess I better sell it. Well, I don't know, should I or shouldn't I? I'm going to hold it. It's Boeing after all. They provide the vast majority of planes to the world. Blah blah blah. We can tell ourselves a million things and a million stories in justification or rationalization of why we want to continue to hold on to a trade. That's fine if that is your trading plan. If your trading plan is I'm buying Boeing, come hell or high water, this thing, I'm going to hold on to it, then great. That's your strategy, that's your plan. You're executing across the plan that you have made. If your plan is to, I'm going to buy only upward sloping momentum style stocks that are only in the momentum zone, which is typically I'm using this 6-month time frame, and I'm grabbing the Fibonacci tool, which is here, and it's going to automatically connect to a swing high, swing low. And now we're using this 236 as our momentum manager and our stop loss manager as well. Okay. If we're doing that, then we've got a pretty fixed methodology. Now we just need to know how many shares am I buying. Now that process comes in next. Again, let's just talk about Allstate right here since it's a good example. Now the other thing is you don't have to always buy on the exact reversal from yellow to green. That's an ideal location just because it's easy to see. It shows up in the scans. It's typically early in the momentum. It gives us structure to what we're looking for and why. If we can get a new buy signal and confirmation bar and some big volume inside of that momentum zone, and we didn't see it that day, but it's still relatively close. We're only 2 days from that confirmation bar. It really hasn't moved much. I could still enter into a trade really at any time because I still have to manage my risk according to where I'm entering the stock. So let's talk about that. In this case, we know that what I prefer to do in utilizing the wheel methodology, the wheel strategy is adding into a stock at a certain cadence, at a certain interval. I do it daily. So the new buy daily wheel strategy is you're buying into a new stock every single day with a certain percentage of your with your approved assets, approved is not the right word. What's the word I'm looking for? My designed assets for this strategy. Okay, so if I'm using 100,000 and this is the methodology that I'm using, okay, whatever that number is, then I'm going to go back in and I'm going to focus on allocation based on that number. And I like 2 to 2.5% for this methodology. Okay, you may go higher than that if you're doing less stocks. You may do lower than that if you're doing more stocks, but we end up with about 20 to 30 holdings at max. We get stopped out of some, we add some back in as it's continually rolling. And ultimately our goal is to just continue to buy stocks that are continually working. The ones that stop working, we get stopped out. We add into something new that has the probability of continuing that overall uptrend. Obviously, we never know which one exactly is going to be the one that becomes the big winner, but we typically get a few big winners, 100% plus, 200%, 300% on some of these stocks, and that might take a few months. Sometimes it takes a few weeks. 6 to 8 weeks typically is about the average holding time. A little bit longer than that if it's a nice, good, solid upward trending stock, and we don't get a ton of momentum out of that. So you can see here, Allstate, not that bad, but year to date it's up 16%. Year over year from a year ago is up 45%. So that's, it's a stock that can move. Sometimes these big, large cap, mega cap stocks, they just can't, percentage wise, they just are too big. They can't move with the kinds of returns that we might want to search for. And that's one of the reasons why we focus on the muscle stock group, this list, because it's going to pull in everything, and it's going to pull in different stocks that are getting a little bit smaller cap stocks, some real big momentum stocks, even the muscle stocks group. You've got stocks like LFMD, and this thing's been going nuts here. It's up 52% in a month, 36% in a week. Okay, now I'm not going to be able to get those type of returns off of Allstate or Disney or Walmart or Costco. Okay, but I can certainly get a stock that is in this medical service or biotech. It's up 700% over the last year, obviously with lots of volatility. There's lots of names that are in there right now. So that's primarily what we're looking for. Here's another one, AQST. In fact, this was a frustrating trade because we entered into this trade right here and we got stopped out of it on this move, and we didn't re-enter back into it, and so we missed this move. That's more frustrating to me than getting stopped out of a trade. It's a trade that would have continued to work had we maintained it, but we continued to follow that plan, get stopped out, just didn't re-enter. And that's neither good nor bad, but it's just showing there, it's okay to get stopped out and then jump back into something that may give you a new trigger and the possibility for big returns in these kinds of stocks. They're very volatile, and that's typically why I use that 2 and 2.5%, because they are so volatile. If this stock dropped by 25% or 30% in one day, then 2% of 100,000 is 2,000, and 10% is 200, 20% is 400. So if this stock dropped by 20% in one day, my position could be exposed to about $300 or $400 at risk. We know that, right? So I may even have a smaller position size on some of these stocks that are just really volatile, so that we can trade them without the volatility being a real big financial risk and emotional risk, because these are swinging all over the place. So that's one of the values of really looking for some of these stocks. Even Root just won't stop. Oh, here's finally a down day, 12%. From 19 to 50 in one straight uptrend. And whatever this news was, whatever happened right here on this massive volume, big uptrend, it absolutely ignited this stock. It became very interesting, and it's just been moving higher. Now we're and that's the other thing, is once we miss out on trades, you see a chart and you're like, oh my gosh, I wish I would have got into that back here. Well, you didn't, and so we have to look at what's the current state. So the current state puts us back into the momentum zone, right? And so a lot of these stocks, you may find that now you're up in this range and you're getting a pullback. Watch for them to pull back to this zone, and then watch for some support. And those can often become great places to be scanning and looking for potential trades. In fact, I typically will do that every morning, where I'll go through this list as well. Because this, for example, this stock, DRCT, has had a big run up, but it's now had a pretty big retracement, but it hasn't even moved back to a hold yet, because this move here had taken it all the way up to extreme. And now it's just moving back out of that extreme range, a little bit deeper retracement back to that 382 and some resistance. But now it's a pullback. It's an opportunity for a new re-entry. So some of the ones that maybe you feel like it's getting away from you, it's rallied too far, but you want to be able to get into it, you can scale that back. You can pull that in. Now, let me go back. I was going to show that example, but let me just show it here on the portfolio. So if I'm adding whatever that number is, if you need to set up a mock account or a simulated account of your exact amount, or similar to it, so that you can quickly determine what your portfolio at risk is. That's one way to be able, quick way to be able to do that, and then continue to use this calculator and then just carry that over into your own brokerage account. But here, if I'm having, I want to focus on the number of shares. If I were to buy this stock today, right now at this moment, DRCT, and I wanted, it's at $27 and I wanted 100 shares, what would that look like? Well, with no stop loss in place yet, okay, I always want to see what does that look like with no stop loss. That puts me at 2.62% of my 100,000. Okay, that is a $2,700 transaction. That's too high. Okay, that's too high. Right now, it's too high in these market conditions. It may be too, it's too high for me. It may be perfect for you. You actually may want to go 5%. Maybe you're going to go, 5%. Let's go 400 or 10% or whatever number that is, 250. Let's go just 200, 5%. Now you can see you've got 5,000 in that transaction. It's a bigger position size. So we're controlling our risk by the position size. So if I want 100, it's 2.62. I'd rather be around that 2% level right here. So let's see what 75 does. That's close to 2%. Now we want to add the stop loss in. If we have 22% right here, or excuse me, $22 just below this low, this kind of this cluster of lows right here. Let's see what that number is. That's 21.20. So if we put a stop at 21, let's see what that does. That puts us at 0.46. What that means is our stop loss is now down right here. And if I said I'm willing to buy the stock right now for this price, which is what it is right now, and I needed to protect that capital, then I'm going to set my stop loss down here. What does that mean if I'm wrong? Okay, that's what we want to worry most about. What happens if I'm wrong? Well, I've got $474 at risk, 23%. For me, that's too much. I want to go down a little bit. So I've got to either adjust the number of shares or the stop loss. That's a wide stop loss. And I want to keep it relatively wide like that. And so I'm going to have this number of shares. I'm going to adjust the number of shares. Let's go down to 60 shares. And that moves this number down to 3.6, 370. So I like to do that about that $350 range. Okay, so if I went down to 50, 30%, $300, that creates a smaller position size. Okay, because the stop is so wide, it ends up making so that my position size is a little smaller. Now I'm in a position that I'm able to absorb an appropriate level of volatility. I'm not saying that I would do this right here, but I would give it a little bit more time. I would want to see another day or two of some support back down here. That's an intriguing bottoming tail bar right here. But when you have a stock that has this momentum, much momentum, and it pulls back, I guarantee you there are buyers ready and waiting on those pullbacks. So they're very attractive stocks on a pullback, even though they're in uptrend. It just doesn't have a confirmation bar. I would prefer a confirmation bar, meaning at least one up day, or at least one up day that's body is closed above the prior day. That's a confirmation bar, or it's closed back up above a prior day of some kind. And so we're a little bit early right here, a little bit premature. But in terms of the structure of the trade management, this is what I'm managing: number of shares, I'm managing my stop price. So I'm managing my position size, I'm managing my stop loss. On any equity trade, stock only trade, that in my opinion is the best way to do it. I don't, you could, without adding complexity, you could certainly add other hedges or options or protective puts or, different things like that. But in terms of just flat out, I just want to buy the stock, and I want to make sure I'm making a prudent decision with the amount of volatility and my risk tolerance. Maybe I'm not a tolerant person to volatility and risk. Well, this is how you control that. You control that with the number of shares, and you control it with your stop loss. Okay, now I know what I'm dealing with. Okay, and so if you don't know this number going into every trade, it just can create some additional stress, some additional confusion, some additional larger losses than you may have anticipated, because I promise you're going to have a stock that reverses and drops 30, 40, 50% in a day. And if that stop loss is not in place, then that's painful. So making sure that those stop losses are managed and position size is set up. This is all kind of high level TradersPro implementation and execution, but essentially just the gist of it, the methodology of it is we're simply looking for high quality names that are moving in an upward trend. And I say high quality, that may be that means that there's demand. Okay, so you have 394 million shares being traded. Okay, there's demand. If it were like 10, 20, 30, 40, 50,000 shares being traded, those are stocks that we want to steer clear from. We want them to make sure that they're listed. They're not OTC stocks. They're listed on an exchange, and ideally, if they have a high rank and there's interest there and they're moving higher, you're going to have institutional players coming into those stocks, and that's ultimately what we want. Is we want to see large momentum on some of these names that are early on. Example, MOD. This stock, it's probably a stock that nobody's ever heard of. They provide essentially refrigeration for trucking companies and buildings, just heating and air conditioning for trucking. And they're doing fantastic, and the stock continues to do well. And it's a $4 billion market cap with average volume of 1 million shares traded per day. Okay, earning money, growing stock. Those are the kind of stocks we're looking for. Look what happened to it. It pulls back, buy the dip. Where's the dip? The dip for us is that 236. Okay, you've got your 6-month time frame. You've got your Fibonacci snap tool that snapped from here. Remember, it's this box. You just simply check box that or uncheck it. If I uncheck it, that's going to disappear. If I check it, now the settings for that is the next box over. Typically the default is this 382506118, and I think this is already set to 236. It's just not checked. So you can set your default right there. And now we've got a couple of different zones, and these are typically the only zones that I'm really ever concerned with as a stock is moving that direction. As it's moving this direction, we're going to deal with this zone first. It's either going to find some support, confirmation, move higher. If we're in the trade, it either stops us out. If we're not, we may have opportunity to add into something new based on that overall pattern. Now we know what we're looking for. We know the kinds of stocks that we're looking for. We know what our expectation is, and now we know how much we should be buying. Okay, we can simply go in, we set up based on our portfolio size, the number of shares, portfolio at risk, and it's a pretty fast process to be able to understand what your risk is, and then at that point you can decide, am I comfortable with that risk or not? That's going to do it for today's update. Everyone have a fantastic day today and a great week. We'll talk to you later. Bye now.